Morning everyone.
Morning.
Welcome to London for those that have travelled. I'm going to give a little bit of an overview, and I think my job is just to provide some context. So it's a little bit skewed towards the housing side, but I guess some of the information, some of the principles may well apply to other sectors as well. I'm, as you can see, the Research and Planning Director for Places for People. So in terms of the overview, quick dip around some of the economy and the political issues, some market dynamics, which is largely housing related. What that means in terms of opportunities and risks for the housing associations, some wider implications on planning performance, and then we'll sort of have a quick review at the end of that. So let's just start with some figures. And the big issue at the moment is growth and public sector debt. So the first two charts, the first one is around growth, and you'll have probably heard the recent figures around that, and you may well have picked up in the recent budget statement the Office of Budget Responsibility, that's the OBR figures as well. This chart looks at from around about now further forward and projects what sort of growth pattern the country is looking at. And you see different projections. You see the Alistair Darling budget before, around about this time last year. You see the first Office of Budget Responsibility budget. You see the November go at that. And then this red line here is CEBR, which is a company we use, an economic consultancy company. Some people are nodding, you may have heard of them. And you can see actually that there's a view out there that there's less economic growth over the next few years than the Office of Budget Responsibility are predicting. Now, the significance of that is the budget is set around the Office of Budget Responsibility's figures, growth figures, and the public sector debt is calculated around those Office of Budget Responsibility growth figures. Welcome. So, with that in mind, and you've got there the lines, the green and the blue line being significantly higher than CEBR's forecast, as an independent forecast, what does that mean for public sector debt? Well, in essence, if this is the public sector debt as we currently sit 2010, 2011, and the projection out over the next 3, 4, 5 years, in essence you see that the budgets from last year in 2010, the blue and the black lines, had it forecasted at around about 20 billion in 2015. The budget a few weeks ago was a slight notch up, and people probably didn't pick that up. So in other words, the original election commitment has already been superseded by a higher public sector debt in 2015, simply because the Office of Budget Responsibility changed their economic forecasts. The tax changes in the budget were neutral, but because the Office of Budget Responsibility forecasts from last year compared to this year were lower, that meant a higher forecast of debt in 2015. And you see the difference then in terms of CEBR's forecast, which is higher still, simply because their view, if you remember from the first chart, was a lower level of GDP. So, where are we then, potentially in 2015? We're potentially in a situation of higher public sector debt than we were told we were to be expected when the Conservative and the Coalition government came into power a year or so ago. And therefore, we can see that the deficit isn't going to reduce as quickly as maybe politicians felt, or that we were maybe all hoping for. And the big threats around that deficit, or indeed the growth, which is the real issue around the deficit, are inflation and energy costs. And I think you're probably aware of the inflation story. Clearly going to peak over the next year or so, with some residual inflation running a year or two after that, which will have some impact on growth. Energy, the Japanese disasters, I think, will have some impact on energy, particularly oil and gas prices, and the current estimate around that is a compound increase of about 10% per annum over the next few years. So there'll be some increase in terms of our inflationary costs, whatever business we're in, and certainly our energy costs, whatever business we're in. What does that mean for registered providers? RPs are registered providers. Well, that effectively has three general impacts. First impact is interest rates. How quickly can the government and the Bank of England consider interest rate rises, given that there's quite a headwind of inflation and a low potential growth. Now, it may not be May now that we'll see an increase in interest rates. Could well be towards the end of the year. I think you can see there that interest rates may not go up as quickly. So there may be some sort of relief in the next year or so from higher interest rates, but over the next few years, as growth comes back, interest rates will go up. And so the holidays we're having at the moment in terms of our interest rate costs in the housing sector, that's our biggest cost, are going to sort of diminish over the years. Clearly, maintenance and other external costs, not just because of the VAT, but the inflation and the energy costs will all get passed through that. And we're already seeing now, if you look at the sector accounts over the last few years, we're seeing maintenance costs being the cost that's going up, more so than management costs and other costs, if you exclude interest rates. And then income levels, personal disposable income levels and benefit rates, people's ability to pay effectively, government's ability to pay, they're getting squeezed, as we'll come on to a bit later. So all in all, what do we think is going to be the government's response to that deficit issue that we pointed out a couple of slides ago in a couple of years' time as we approach the next election? And it's interesting, isn't it? Because you can see some of the medium and long-term scenarios panning out in different ways. Will the government, the coalition government before the next election, or indeed a government before the next election, will it look to introduce more tax and public expenditure cuts? Does it matter? The second point is, does it matter? Was it really just, was the budgets, the emergency budget and this last budget, just there to cut the government public expenditure? Was that the real issue? If a new government came in, if it was Labour or it was another form of coalition, would or could they do anything different? An interesting thing around that is when you go and speak to some Labour MPs, and part of my job is to speak to MPs, they're in a different place to where they were before the election. They're more in the place that you would see the coalition government. They're accepting that it should be CPI, not RPI, that drives benefits. They're accepting that if you're in the housing industry, that at some point in the future, arrears should, benefit payments should get paid direct to customers, which is potentially going to have a problem in terms of arrears in the housing sector. So the Labour government are getting themselves into a similar position. Could they unwind the deficit issue? Probably not. So all in all, these medium and long-term scenarios have different options. Some cases along the continuum, it might be we'll accept a deficit, just like Sweden accepts a deficit. Or it could be we're going to have to go even further than we've actually planned to go. And it's that continuum, those scenarios that are really going to be important to the housing sector over the next few years to get their heads around when they're planning their business. I think the reality is, though, whichever way you look at it on that continuum, the housing sector itself is now, and it will be, in a very different world to what it has been in the past. The 4.5 billion grant that was halved, that's now on the table, will probably get halved again in a few years' time. It's viewed increasingly by most parties as being more of a private sector than a public sector operation. That's the way, that's the reality of where people are thinking now. The issue to do with finance, we know, is tight, and I go to conferences probably like yourselves, and I hear banks saying it's really tight for the next few years because we're having to pay back the special liquidity scheme, we're having to pay back the government loans that they've given us over the next couple of years. We've got Basel II, we've got Basel III that stops us lending risky capital. And by the way, there's only 6 of us that's really lending into the housing sector, so we've got counterparty risks. How much would we expose ourselves to new lending in the housing sector? So not just corporate lending, but mortgage lending is incredibly tight. The risks around first-time buyers and the capital around 95%, the capital lock-up of the Basel III. All of these things are really tight for the housing sector. And will be, I think, not just for the next few years. I think that they're here to stay. And then finally, customers, finding it difficult to respond to the demand that they want for home ownership or partial home ownership because of their income levels, because of the lack of mortgages. Again, it's here to stay for the next few years, at least, if not 5 to 10 years. We're in that affordability trap of that intermediate housing market where customers who want home ownership probably don't quite have all the full means to do it, need to have some form of products to enable them to access it. And that intermediate market, in my view, is the one that we've been tracking now for a couple of years, and that's where the growth's going to be in terms of housing demand and housing need.